Before we begin, please note that I am not a financial advisor, a lawyer, or a certified public accountant. This video is for informational and educational purposes only and should not be considered legal or financial advice. The world of cryptocurrency regulation is complex and constantly changing. Always consult with a qualified professional before making any financial decisions. The single biggest threat to your crypto portfolio isn't a market crash. It's not a hacker from halfway across the world. It's a single sentence buried deep inside a 1,000-page document from Washington, D.C. that you've never even heard of. You bought some Bitcoin on Coinbase. Maybe you threw $100 at a promising altcoin your friend mentioned. You felt the thrill of being early to a new financial frontier. But now you hear the whispers on the news, words like SEC, crackdown, IRS, and enforcement. And suddenly, that exciting investment starts to feel less like a lottery ticket to the moon and more like a ticking time bomb you have no idea how to defuse. You're not alone. Millions of Americans are in the exact same boat, floating in a sea of confusion, wondering if they've accidentally broken a law they didn't even know existed. This is the problem. The rules of the game are being written as we play, and the referees in Washington are blowing the whistle, but no one seems to have a copy of the rulebook. Until now. The purpose of this presentation is to give you that rulebook, to take this chaotic, intimidating world of US crypto regulation and make it simple, to turn the legal jargon into plain English, to give you a clear step-by-step roadmap so you can navigate this new landscape with confidence, not fear. We are going to demystify the headlines and arm you with the knowledge you need to protect your assets and invest smarter. We're going to transform you from a confused spectator into an informed participant. And make no mistake, the time to get informed is right now. The Wild West era of crypto is officially over. For years, the US government took a mostly hands-off approach, watching from the sidelines as this strange new technology grew. But those days are gone. The market is now worth trillions of dollars, and it's deeply intertwined with our regular economy. The government can't ignore it anymore. They see the potential for massive tax revenue. They see the risks of fraud and market manipulation. And they see the need to establish the United States as a leader in the future of finance. So the regulators are moving in, and they're moving in fast. Ignoring these changes is like driving on a brand new highway with no signs, no speed limits, and police cars appearing around every corner. It's a recipe for disaster. This series is for you if you've ever bought, sold, or even just held cryptocurrency in the United States. It doesn't matter if you have $10 in Dogecoin or $10,000 in Ethereum. If you're a beginner who feels overwhelmed by the complexity, this is your starting point. You don't need a law degree or a background in finance. All you need is the desire to understand the forces that are shaping the future of your money. Over the next few parts, we're going to build your knowledge from the ground up. We'll start by understanding the big picture, why the government is even bothering to regulate crypto in the first place. Then we'll dive headfirst into the topic everyone dreads: taxes. We'll break down exactly what you need to report to the IRS, how to do it, and how to avoid the most common costly mistakes. From there, we'll explore the huge, ongoing battle between the big federal agencies, the SEC, the CFTC, the Treasury, as they fight for control, and we'll explain what their fight means for the specific coins in your wallet. We'll look at stablecoins, NFTs, and DeFi, and finally, we'll gaze into the crystal ball and discuss where these regulations are headed in the future. By the end, you'll have a complete framework for understanding US crypto policy. So let's begin with the most fundamental question of all. Why? Why is the US government suddenly so intensely focused on regulating digital assets? It's not just one reason. It's a handful of powerful motivations all converging at once. First, and perhaps most importantly in their public statements, is consumer protection. Let's be honest, the crypto space can be a minefield of scams, hacks, and outright fraud. You've heard the horror stories. People losing their life savings to a fake Elon Musk giveaway on Twitter, or a promising new project turning out to be a rug pull, where the developers just vanish with everyone's money. We saw the collapse of massive platforms like FTX and Celsius, where billions of dollars in customer funds evaporated overnight, leaving everyday investors with nothing. From the government's perspective, this is unacceptable. They see it as their duty to put up guardrails, to protect citizens from predatory actors, and to ensure that if you invest your money on a platform, it's actually safe. They want to impose rules on crypto exchanges similar to the rules that govern the New York Stock Exchange, rules about transparency, capital reserves, and what happens if the company goes bankrupt. It's about preventing the next FTX from ever happening again. The second major driver is national security and the prevention of illicit finance. Because of its pseudo-anonymous nature, crypto has long been the currency of choice for criminals, terrorist organizations, and rogue nations looking to evade economic sanctions. It can be used for money laundering, funding illegal activities, and moving money across borders without a trace. Agencies like the Treasury Department are laser-focused on cutting off these financial streams. They're implementing stricter Know Your Customer and anti-money laundering, what you'll see called KYC and AML, rules on crypto exchanges. This is why you now have to upload your driver's license and social security number to use platforms like Coinbase or Kraken. They are creating a paper trail, or rather a digital trail, to make it much harder for bad actors to use the crypto ecosystem for illegal purposes. Third is the goal of maintaining financial stability. This one is a bit more abstract, but it's a huge concern for institutions like the Federal Reserve. Their nightmare scenario is a world where the crypto market becomes so large and interconnected with the traditional banking system, what we call TradFi, that a massive crypto crash could trigger a full-blown financial crisis, like the housing market collapse of 2008. Imagine if major banks started holding huge amounts of Bitcoin on their balance sheets, or if a popular stablecoin, a coin supposedly pegged to the US dollar, suddenly failed. The ripple effects could be catastrophic for the entire economy. Regulators want to build firewalls between crypto and traditional finance to contain the risk and ensure the stability of the US dollar and our banking system. And finally, the reason that probably affects you the most directly, taxes. The Internal Revenue Service, the IRS, knows that there are potentially hundreds of billions of dollars in unrealized capital gains sitting in the crypto market, and they want their cut. For a long time, many crypto investors operated under the mistaken belief that their transactions were anonymous and untraceable, and therefore untaxable. That is dangerously false. The IRS has been very clear. Crypto is treated as property for tax purposes. This means every time you sell, trade, or even use your crypto to buy something like a cup of coffee, you are creating a taxable event. The government is now investing heavily in blockchain analysis tools and forcing exchanges to report user data to make sure every last dollar of tax revenue is collected. They are not asking anymore. They are demanding. So, to recap, they're regulating to protect you from scams, to stop criminals and terrorists, to prevent a financial meltdown, and to collect taxes. These four pillars form the foundation of the entire U.S. regulatory strategy. Understanding this why is the crucial first step. It's not just random rules being thrown at a new technology. It's a deliberate, multifaceted effort by the most powerful government on Earth to bring order to a chaotic new frontier. But knowing why they're creating rules is one thing. The real fight, the multi-trillion-dollar question that has Washington tied in knots and is making crypto founders sweat, is about what crypto actually is in the eyes of the law. This is where the entire debate truly begins, and it all boils down to one monumental conflict. Is a cryptocurrency a security like a stock, or is it a commodity, like gold or oil? The answer to that single question changes everything about how it's regulated, who regulates it, and what the future holds for the coins in your portfolio. It's the difference between a bright future and a brutal crackdown. And figuring out that distinction is exactly where we're going next. To understand the battle for the soul of crypto, I want you to imagine something. Imagine a team of explorers discovers a brand new, never-before-seen creature deep in the Amazon. It's fascinating. It has features of a mammal, but it lays eggs like a reptile. It can fly, but it has gills for breathing underwater. It's unlike anything science has ever encountered. Now, back in the civilized world, two different government agencies show up, both claiming jurisdiction. The first is the Department of Fish and Wildlife. They say, look, it's an animal. It lives in the wild. It's clearly our responsibility. But then the Federal Aviation Administration shows up and says, hold on, you said it can fly. Anything that operates in the airspace falls under our rules. We need to regulate its flight paths. This absurd argument is almost a perfect metaphor for what's happening in the United States with crypto right now. We've discovered this new, groundbreaking technology, and the old guard regulators are trying to stuff it into pre-existing boxes that it was never designed to fit in. And the two main agencies fighting for control, our Fish and Wildlife and our FAA, are the Securities and Exchange Commission, the SEC, and the Commodity Futures Trading Commission, the CFTC. This isn't just some bureaucratic squabble. This is the multi-trillion-dollar question. The answer determines the fate of the entire industry in America. So let's meet the two contenders in this regulatory cage match. In one corner we have the heavyweight champion, the big one, the SEC, the Securities and Exchange Commission. When you think of Wall Street, the stock market, and big investment banks, you're thinking of the SEC's turf. Their primary mission, established way back in the 1930s after the Great Depression, is to protect investors. They do this by making sure that when you invest your money into something, you're getting a fair shake. They enforce rules about transparency, disclosure, and fraud. If a company wants to sell shares of its stock to the public, they have to go through a grueling, expensive registration process with the SEC. They have to open up their books, reveal their business plans, and continuously report on their financial health. The SEC's entire worldview is built around the concept of a security. And for the SEC, a security is a very specific thing. It's an investment of money in a common enterprise with the expectation of profit to be derived from the efforts of others. Remember that phrase. It's the key to everything. In the other corner, we have the CFTC, the Commodity Futures Trading Commission. They're the regulators of a different kind of market. The CFTC oversees markets for commodities. Now, what's a commodity? Think of raw materials: gold, oil, wheat, corn, soybeans. These are things that are more or less uniform no matter who produces them. A barrel of West Texas Intermediate crude oil is the same whether it comes from well A or well B. You're not investing in the oil company's management team to make your oil barrel more valuable. You're betting on the supply and demand of the raw material itself. The CFTC's job is to make sure these massive, important markets for raw goods are stable and free from manipulation. Their regulatory touch is different from the SEC's. It's less about the disclosures of a single company and more about the integrity of the overall market. So you have the SEC, the cop for investments in a company, and the CFTC, the cop for raw goods. And then along comes crypto. Is Bitcoin a security or a commodity? Is Ethereum a security or a commodity? What about the thousands of other tokens out there? Is it a stock in Crypto Incorporated? Or is it a digital version of gold? The SEC, led by its current chairman Gary Gensler, has a very clear, very loud opinion. Almost every single crypto token, with the possible exception of Bitcoin, is a security. And his entire argument hinges on a nearly 90-year-old Supreme Court case involving Florida orange groves. Yes, you heard that right. The future of decentralized digital finance is being decided by a case about citrus fruit from 1946. It's called SECV. W. J. Howey Company, and it is the single most important piece of legal precedent you need to understand in this space. The story is simple. Back in the day, the Howey Company owned a bunch of orange groves in Florida. They came up with a clever business plan. They sold off small rows of their orange trees to individual buyers, many of whom were tourists who lived out of state. But here's the catch. Buying the land wasn't the real product. The Howey Company also offered a service contract. They said, "You buy the land, but let us, the experts, cultivate the trees, harvest the oranges, and sell them. We'll pool all the oranges together, sell them on the market, and then you, the landowner, will get a share of the profits." The buyers weren't interested in becoming orange farmers. They were investing money, hoping that the Howey Company's efforts would generate a return for them. The SEC saw this and said, "Wait a minute. This isn't just a real estate deal. This is an investment contract. It's a security." The case went all the way to the Supreme Court, which sided with the SEC. And in doing so, they created a simple four-part test to determine if something is an investment contract, and therefore a security. This is now famously known as the Howey test. Here are the four pillars. 1. Is there an investment of money? 2. Is that money invested in a common enterprise? 3. Is there an expectation of profits from the investment? And 4. Are those profits derived from the efforts of a promoter or a third party? If the answer is yes to all four, then congratulations, you have a security. And the SEC says it's theirs to regulate. Now let's apply this to crypto. Think about a typical initial coin offering or ICO from a few years ago. 1. Did you invest money? Yes, you sent them Bitcoin or Ethereum. 2. Was it a common enterprise? Yes, everyone's money was pooled together to fund the project. 3. Was there an expectation of profit? Absolutely. You weren't buying the token to use it on day one. You were buying it because you hoped the price would go to the moon. And the crucial fourth point. Were those profits dependent on the efforts of others? Yes. You were counting on the founding team, the developers, the marketers to build the network, create partnerships, and do all the work that would make your token more valuable. You can see how neatly this fits. The ICO project looks a lot like the Howie Company. The investors are like the tourists buying the orange trees. The founding crypto team is like the expert farmers promising to make the investment profitable. From the SEC's perspective, it's an open and shut case. Most tokens that had a fundraising event look, smell, and taste like securities. But what about the other side? The CFTC and crypto advocates push back, especially when it comes to the big, established networks like Bitcoin. Let's run Bitcoin through the Howey test. 1. Investment of money? Yes. 2. Common enterprise? This gets tricky. The Bitcoin network is decentralized. There's no central company pooling the funds. 3. Expectation of profit? Yes, for most people. But it's the fourth prong where the argument really lives. Are profits derived from the efforts of others? Who are the others? There is no Bitcoin CEO. There is no Bitcoin headquarters. The founder, Satoshi Nakamoto, is anonymous and disappeared over a decade ago. The network is maintained by a decentralized group of miners all over the world. Its value comes from its code, its network effect, and market supply and demand, not from a management team making quarterly promises. It behaves much more like a digital commodity, like gold. No one is managing gold to make it more valuable. Just as this is the fundamental conflict. The SEC sees centralized teams raising money and promising returns. The CFTC sees decentralized networks functioning like digital raw materials. And the stakes of this fight are astronomical. If the SEC wins and most cryptos are declared securities, it would be an earthquake. Every crypto project would potentially need to register with the SEC, a process that is so complex and expensive it could wipe out most startups. Exchanges like Coinbase or Kraken would be considered unregistered securities exchanges, putting them in immense legal jeopardy. Tokens could be forcibly delisted, wiping out billions in investor value overnight. The industry as we know it would be forced to conform to a regulatory structure designed for stocks and bonds, a structure it was fundamentally built to innovate beyond. If the CFTC gets more authority, or if Congress creates a new framework, the path could be very different. The rules might be more tailored to the technology, focusing on market integrity, consumer protection against fraud, and clear rules of the road without necessarily stifling innovation. It could lead to a world where crypto is a legitimate, recognized asset class with its own set of bespoke regulations. So this isn't just an argument about definitions. It's a fight for the future. It's a battle between the old world of finance and the new, with both sides trying to use century-old laws to govern 21st century technology. The outcome is anything but certain, and major court battles are being fought right now that are drawing the lines on this new map. Those legal brawls, the landmark cases that are setting the precedents for your portfolio, are where the real story is unfolding. And diving deep into those epic courtroom showdowns is exactly what we'll do next. To understand the battle for crypto's soul in America, you don't go to a tech conference. You go to a federal courthouse. Because this isn't just a debate over code, it's a high-stakes legal war. And the most legendary battle, the one that sent shockwaves through the entire industry, is the United States Securities and Exchange Commission versus Ripple Labs. It all started in December 2020. The SEC, the top cop of Wall Street, kicked down the door and pointed a finger at Ripple, the company behind the digital asset XRP. Their accusation was simple, yet catastrophic. The $7 billion worth of XRP that Ripple had sold over the years wasn't a currency or a commodity. The SEC claimed it was a security, an unregistered security. Essentially, they accused Ripple of conducting one of the largest unlicensed stock offerings in history. Now, for this to make any sense, you have to understand the ghost that haunts all of crypto regulation. A 1946 Supreme Court case about a Florida orange grove. Seriously, it's called the Howey test, and it's the legal yardstick the SEC uses to decide if something is a security. The test has 4 parts, but it boils down to one simple idea. Are you investing money in a common enterprise, with the expectation of profit, based primarily on the efforts of others? Think about that orange grove. You buy a plot of land. You're not planning to fly to Florida and pick oranges yourself. You're counting on the company W.J. Howey Company to manage the grove, harvest the fruit, sell it, and send you a check. You invested money in a common enterprise, the grove, expecting profits from their work. That, the Supreme Court said, is a security. The SEC looked at Ripple and saw an orange grove. They argued that people bought XRP tokens, investing money into the common enterprise of the Ripple ecosystem, expecting the price to go up based on the work of Ripple Labs, their software development, their banking partnerships, their marketing. To the SEC, buying XRP was no different than buying a share of early Apple stock. You buy it because you believe the company is going to do things that make your investment more valuable. Ripple's defense was a full-throated roar of defiance. They argued that this was insane. XRP, they said, is a piece of technology. It's a digital asset that functions as a bridge currency, allowing banks to move money across borders faster and cheaper than the old, clunky systems. People buy it and use it for its utility, just like people buy Japanese yen or British pounds to conduct business. They pointed out that the Treasury Department had already classified XRP as a virtual currency years earlier. They essentially told the SEC, you can't just change the rules of the game decades later. You're trying to fit a square peg into a round hole, and you're destroying American innovation in the process. For nearly 3 years, the two sides were locked in a brutal legal war, costing Ripple over $200 million in legal fees. The entire crypto world held its breath. If the SEC won, if a court declared that XRP was a security, it could create a domino effect. Dozens, if not hundreds, of other cryptocurrencies that raised money in similar ways could be next on the chopping block. Exchanges that listed them could be deemed illegal stock exchanges. The stakes were astronomical. Then, in July of 2023, the verdict dropped, and it was a bombshell nobody saw coming. The judge, Analisa Torres, split the baby in half. She delivered a nuanced ruling that was a stunning victory for Ripple, but also gave the SEC a crucial win. Here's what she decided, and this is the single most important part to understand. It all depends on who bought the XRP and how they bought it. The judge said that when Ripple sold XRP directly to big, sophisticated institutions, hedge funds, venture capitalists, those sales were illegal securities offerings. Because in those deals, the institutions were buying directly from Ripple with a clear understanding that Ripple's efforts would increase the value. That was the orange grove. But, and this is the part that made the crypto market explode with joy, the judge ruled that when the average person, someone like you or me, bought XRP on a public exchange like Coinbase or Kraken, those sales were not securities transactions. Her logic was fascinating. She said that when you buy XRP on an open market, you don't know if you're buying it from Ripple or from some other random person. You're not entering into a contract with Ripple. You're just buying a digital asset at the market price. You have no reasonable expectation that your purchase comes with a promise of future work from the company that created it. In that context, XRP was just a token, not a security. The implications were massive. For the first time, a U.S. federal court had drawn a line in the sand. It established a legal precedent that a digital asset itself is not inherently a security. Its status depends on the context of its sale. This ruling was a shield. Suddenly, crypto projects across the country had a legal argument to defend themselves against the SEC. It was a crack in the dam of the SEC's regulation by enforcement strategy. But don't think for a second the SEC just packed up and went home. They didn't. They saw the Ripple decision as a partial loss, not a total defeat. And so they pivoted. They sharpened their knives and went after the heart of the American crypto ecosystem itself, the exchanges. This brings us to the second titanic legal battle, SEC versus Coinbase. If the Ripple case was about the nature of a single coin, the Coinbase case is about the nature of the entire marketplace. The SEC sued Coinbase, the largest and only publicly traded crypto exchange in the United States, with a sweeping set of allegations. They accused Coinbase of operating as an unregistered national securities exchange, broker, and clearing agency, all rolled into one. The SEC's argument is this: Coinbase lists dozens of tokens that the SEC believes are securities. By letting people buy and sell these tokens, Coinbase is acting just like the New York Stock Exchange. But the SEC claims they never registered. They never got the license. It's like opening a massive casino on the Vegas Strip without a gaming license. Furthermore, they accused Coinbase staking service, where users can lock up their crypto to earn rewards, of being an illegal investment contract. Coinbase's defense is one that resonates deeply with many in both the tech and financial worlds. For years, their CEO Brian Armstrong has publicly stated that they have gone to the SEC over and over again, asking for a clear rulebook. They've said, "Tell us the rules for crypto and we will follow them." But according to Coinbase, the SEC refused to provide clear guidance. Instead, the agency's only answer is a lawsuit. Coinbase is arguing that the laws the SEC is trying to use, laws written in the 1930s to regulate stocks and bonds, simply do not work for this new technology. They are fighting not just for their own survival, but on the principle that the government shouldn't be allowed to regulate through ambush and intimidation. They are demanding that Congress, not an unelected agency, should be the one to write the laws for the future of the digital economy. These two cases, Ripple and Coinbase, are not just corporate disputes. They are the crucibles where the future of your right to buy, sell, and use digital assets in America is being forged. The outcome will determine whether crypto is treated like a stock, a commodity like gold, or something entirely new. It will decide whether innovation flourishes within the United States or flees to more welcoming shores in Europe and Asia. The SEC, with its army of lawyers and its century-old rulebook, is the loudest and most powerful player on the field, trying to referee a game it doesn't fully understand. But here's the thing you have to remember. They're not the only ones with a whistle. Other powerful federal agencies are watching from the sidelines, and they're starting to step onto the field. They have their own ideas about what crypto is, and their game has a completely different set of rules. Think of it like a regulatory turf war, a high-stakes battle for control over the future of money, and you're caught in the middle. In one corner you have the SEC swinging the Howey test like a hammer, seeing every new crypto project as a potential nail and unregistered security. But in the other corner stands a heavyweight contender with a completely different playbook: the Commodity Futures Trading Commission, or the CFTC. Now, if the SEC is the cop for stocks and bonds, the CFTC is the sheriff for commodities. What's a commodity? Think of the raw, fundamental building blocks of the economy: gold, oil, wheat, corn, pork bellies. These are things that are standardized, interchangeable. One barrel of West Texas Intermediate crude oil is pretty much the same as any other. You don't invest in the corn company. You buy corn itself, hoping its price will go up. The CFTC and a huge portion of the crypto world argue that Bitcoin isn't a security. You're not buying a piece of the Bitcoin Corporation. There is no CO. There are no quarterly earnings reports. There was no ICO promising future profits based on the efforts of a management team. Instead, they argue Bitcoin is a digital commodity. It's like digital gold. It's a scarce, verifiable digital asset that acts as a store of value. And if Bitcoin is a commodity, it falls squarely under the CFTC's jurisdiction, not the SEC's. This isn't just a philosophical debate. It has massive real-world consequences. The CFTC's regulatory approach is generally seen as more hands-off than the SEC's. They regulate the trading of futures and derivatives based on commodities, but they don't police the underlying commodity itself in the same way the SEC polices stocks. So, if you're a crypto project, being labeled a commodity is like being told you can play in the park. Being labeled a security is like being told you have to fill out a mountain of paperwork and ask for permission just to step on the grass. This is the fundamental conflict at the heart of American crypto regulation. The SEC and the CFTC are in a power struggle, pointing at the same digital assets and shouting, "That's mine." The SEC under Gary Gensler has been incredibly aggressive, claiming almost everything except Bitcoin is a security. Meanwhile, the CFTC has been just as vocal, filing its own lawsuits against crypto players like the exchange Binance, claiming that assets like Ethereum and Litecoin are commodities. The result is a confusing mess where exchanges and investors are caught in the crossfire, unsure which rulebook to follow because the referees can't even agree on what game they're playing. But the fight between the SEC and the CFTC is only the opening act. There's another, even more powerful government entity that doesn't really care what you call crypto. They don't care if it's a security or a commodity. They only care about one thing: where the money is going. And that is the United States Department of the Treasury. The Treasury is the financial fortress of the US government, and within its walls are two agencies that every crypto user needs to understand. The first is FinCEN, the Financial Crimes Enforcement Network. Their job is simple and terrifying. They hunt money launderers and terrorist financiers. For years, crypto's biggest PR problem was its association with dark web markets and illicit activity. FinCEN is the agency tasked with cleaning that up. This is why, when you sign up for an exchange like Coinbase or Kraken, you can't just create an anonymous account with an email address. You have to go through a process called KYC, or Know Your Customer. You have to upload your driver's license, give your social security number, maybe even take a selfie. That's not Coinbase being nosy. That's Coinbase complying with FinCEN regulations, the same anti-money laundering rules that your bank has to follow. FinCEN's logic is that if every on-ramp and off-ramp between crypto and traditional dollars is monitored, it becomes much harder for bad actors to use the system. They are, in effect, forcing the crypto world to adopt the surveillance and reporting standards of the old world financial system. But the second agency within the Treasury is the one that truly affects every single person holding even a dollar's worth of crypto. It's the one agency no American can escape: the IRS, the Internal Revenue Service. And here is where we get to one of the single most misunderstood and most important aspects of crypto in the United States. The IRS has a very specific view on crypto, and it's a bombshell for most beginners. The IRS does not see cryptocurrency as currency. Let me repeat that. The tax man does not consider your crypto to be money. So what do they see it as? Property. That one word changes everything. The IRS treats your Bitcoin, your Ethereum, your Solana exactly the same way it treats a stock, a bond, or a piece of real estate. And this has staggering implications. When you sell a stock for more than you paid for it, you have a capital gain, and you owe the government a piece of that profit. Because the IRS views crypto as property, the exact same rule applies. Every single time you sell your crypto for dollars, that is a taxable event. Every time you trade one crypto for another, say you trade your Ethereum for a new altcoin, that is also a taxable event. The IRS sees it as you selling your Ethereum to buy the other coin. You have to calculate the dollar value at the moment of the trade to see if you made a profit on your Ethereum, and if you did, you owe tax on it. But here's the part that truly breaks people's brains. Because it's property and not currency, every time you use crypto to buy a good or a service, it is a taxable event. Let's walk through an example. Say you bought one Bitcoin years ago for $1,000. Today, that Bitcoin is worth $50,000. You feel great. You decide to use a tiny fraction of it to buy a $5 coffee. In your mind, you just spent $5. But in the eyes of the IRS, you just sold $5 worth of property. You have to calculate the cost basis of that specific fraction of a Bitcoin you spent. Since you bought it when the price was much lower, you have realized a capital gain. On that $5 coffee, you might owe the government, say, 90 cents in capital gains tax. Now imagine doing that for every single purchase. A coffee, pizza, a new laptop, a car. You would need to keep a detailed spreadsheet of the exact date, time, and dollar value of every single transaction you ever make with crypto, just to calculate your taxes. It turns the dream of a new digital cash system into an absolute accounting nightmare. This is why specialized crypto tax software has become a booming industry. It's a direct result of this crypto as property, ruling by the IRS. They are watching and they are expecting you to report everything. So we have the SEC fighting the CFTC over what crypto is. We have FinCEN watching how crypto moves. And we have the IRS taxing crypto every time it does anything. It's a regulatory minefield. And just when you think it can't get any more complicated, the final boss enters the room: the Federal Reserve. The Fed, the central bank of the United States, isn't focused on individual coins or your tax bill. They're worried about the stability of the entire US dollar and the banking system itself. They're looking at stablecoins like Tether and USDC, which are pegged to the dollar, and they're getting nervous. These are multi-billion-dollar pools of capital operating largely outside of traditional banking regulations. The Fed worries, what happens if there's a run on the bank for a major stablecoin? What if it collapses? Could it trigger a financial crisis? Their solution might not be to regulate crypto, but to compete with it. The Fed has been actively researching and debating the creation of its own central bank digital currency, or CBDC, a digital dollar. It would be a new form of money, issued directly by the government, programmable and traceable. It's the ultimate government response. If you can't control the new technology, you create your own version that you can control completely. This alphabet soup of agencies, the SEC, CFTC, FinCEN, IRS, and the Fed, are all pulling in different directions. They have conflicting definitions, competing jurisdictions, and entirely separate goals. They've created a chaotic, confusing, and often hostile environment for crypto in the US. But this regulatory chaos isn't just happening in agency boardrooms. It's exploding into the one place where rules are truly made and broken in America: the court system. And the legal battles being fought right now are going to decide the future of your crypto. We're talking about landmark lawsuits that could send shockwaves through the entire industry. And first up in the ring, the heavyweight title fight that has the entire crypto world holding its breath. The U.S. Securities and Exchange Commission versus Ripple Labs. This isn't just a lawsuit. It's a battle for the very definition of what a cryptocurrency is in the eyes of American law. To understand this fight, you need to understand the SEC's primary weapon. It's a legal doctrine from a 1946 Supreme Court case involving a Florida orange grove. Seriously, it's called the Howey test, and for nearly 80 years, it has been the definitive test for what constitutes an investment contract, which is a type of security. If something is a security, it falls under the SEC's iron-fisted rule. Picture this: back in the 40s, a company called the W.J. Howey Company was selling plots of its orange grove to investors. But you didn't just buy the land. You also signed a service contract for Howey to cultivate, harvest, and market the oranges for you. You, the investor, just sat back and collected a check from the profits. The Supreme Court looked at this and created a four-part test. For something to be a security, there must be 1. An investment of money, 2. In a common enterprise, 3. With a reasonable expectation of profits, and 4. To be derived from the efforts of others. The SEC looked at Ripple and its token XRP and said, "This looks a lot like an orange grove to us." Their argument was simple: Ripple created billions of XRP out of thin air. They then sold it to the public, raising over $1 billion. People who bought XRP, according to the SEC, were investing money into a common enterprise, the Ripple ecosystem, with the expectation of profit, based on the managerial efforts of the Ripple company to promote and develop XRP's network. Check, 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 and check. To the SEC, XRP wasn't a currency. It was an unregistered security, and Ripple was conducting a massive illegal securities offering. Ripple fired back with a completely different vision. They argued XRP is not a share in their company. It's a technology. It's a digital asset designed to be a bridge currency, to make international payments faster and cheaper than the ancient SWIFT system that banks still use. They claimed people were buying XRP for its utility, to use it, not just as an investment based on Ripple's work. They pointed out that once you buy XRP, Ripple has no ongoing obligation to you, unlike a company that sells you stock. They were essentially saying, you're using an 80-year-old test for oranges to regulate a 21st century digital currency. It doesn't fit. For years, the two sides were locked in a brutal multi-billion-dollar legal war. The entire crypto industry watched, because if the SEC won, the precedent would be catastrophic. It could mean that almost every single cryptocurrency, except maybe Bitcoin, could be declared an illegal security. The consequences would be devastating. Exchanges would have to delist them, projects would shut down, and the American crypto industry would be sent back to the Stone Age. Then, in July of 2023, the bombshell dropped. A federal judge, Annalisa Torres, delivered a landmark ruling that sent shockwaves through the financial world. And it was a stunning, nuanced decision. It wasn't a clear win for either side. It was something far more interesting. Judge Torres split her decision into two key parts. First, she looked at the sales Ripple made directly to big institutions, hedge funds, big money investors. She said those were securities. Why? Because those institutions were sophisticated buyers who knew they were investing in the Ripple enterprise. They were buying with the explicit understanding that Ripple's efforts would increase the value of their holdings. That was a win for the SEC. But then came the part that mattered to you, to the average person buying crypto on an exchange. Judge Torres looked at what are called programmatic sales. That's the fancy term for when Ripple sold XRP on exchanges like Coinbase or Binance to the general public. And here, she ruled that these sales were not securities offerings. Her reasoning was revolutionary. She said that when you or I buy XRP on an open exchange, we don't know if we're buying it from Ripple or from some other random person. We aren't signing a contract with Ripple. We have no expectation of profit based specifically on their efforts. We're just trading an asset on a secondary market, much like you trade baseball cards or gold, or a currency. This was a monumental victory for the crypto industry. The ruling essentially created a legal argument that a token itself is not a security. It's just code. The manner in which it is sold is what matters. Selling it to a hedge fund behind closed doors is one thing. Selling it to the public on an anonymous exchange is another. This distinction blew a massive hole in the SEC's strategy of just pointing at a token and yelling security. But don't pop the champagne just yet. The SEC is appealing the decision, and this fight is far from over. And while they were fighting Ripple, the SEC opened up a new, even bigger front in this war. They decided that if they couldn't easily kill the individual tokens, they would go after the marketplaces where they are traded. They went after the biggest, most regulated, publicly traded crypto exchange in the United States, Coinbase. The SEC's lawsuit against Coinbase is in many ways far more terrifying than the Ripple case. It's not about one asset. It's an attack on the entire business model of a crypto exchange. The SEC alleges that Coinbase is operating as an unregistered national securities exchange, broker, and clearing agency all in one. They identified at least 13 specific tokens traded on Coinbase, including popular ones like Solana, Cardano, and Polygon, and declared them to be securities. They are basically saying to Coinbase, "You are illegally facilitating the trade of unregistered securities to the American public." But they didn't stop there. They also went after Coinbase staking service. Staking is where you lock up your crypto to help secure the network, and in return you earn rewards, kind of like earning interest in a savings account. The SEC claims that these staking programs are also investment contracts. They argue that when you stake your coins through Coinbase, you're investing your assets, expecting a profit, based on Coinbase managerial efforts to run the staking infrastructure. It's the Howey test all over again, applied to a core function of the crypto ecosystem. The implications here are staggering. If the SEC wins against Coinbase, it could force every US crypto exchange to either register with the SEC, a process so complex and expensive it could bankrupt them, or delist hundreds of tokens, effectively cutting off American access to a huge portion of the crypto market. Your favorite altcoin? It could vanish from US exchanges overnight. Your ability to earn staking rewards? That could be deemed an illegal securities offering. This lawsuit isn't a targeted strike. It's a carpet-bombing campaign aimed at the heart of the US crypto economy. Coinbase is fighting back hard. They argue they've tried to register with the SEC for years, but the SEC has provided no clear path to do so. They argue the SEC is engaging in regulation by enforcement. Instead of writing clear rules for everyone to follow, they are just suing people and trying to create law through court cases. It's an unpredictable, chaotic way to regulate an entire industry. So now we have this two-front war. The SEC is fighting the creators of tokens like Ripple and the marketplaces that list them like Coinbase. These legal battles are a slow-motion war that will take years to fully resolve through the appeals process. The outcome of these cases will fundamentally write the rulebook for crypto in the United States. But here's where it gets even more complicated. The SEC isn't the only powerful regulator in Washington, D.C. with its eyes on crypto. There's another agency, a powerful player that regulates things like oil, wheat, and gold. And they believe that crypto belongs to them. This has set the stage for a massive turf war between two of America's most powerful financial regulators, a battle of titans that leaves the crypto industry and your portfolio caught in the crossfire. So who are these titans? In one corner, you have the heavyweight champion of Wall Street, the Securities and Exchange Commission, better known as the SEC. Their job for the last 90 years has been to protect investors. They regulate stocks, bonds, and anything that qualifies as a security. Their mission is to make sure that when you invest your hard-earned money into a company, that company isn't lying to you. They demand transparency, they enforce rules, and they bring the hammer down on fraud. Their entire worldview is built around a central idea: protecting the little guy from big, powerful corporations. In the other corner, you have the Commodity Futures Trading Commission, the CFTC. They're the guardians of a different kind of market. They don't regulate companies, they regulate commodities. What's a commodity? Think of the raw materials that power our world: oil, gold, corn, wheat, soybeans. These are basic interchangeable goods. 1 barrel of West Texas Intermediate crude oil is the same as any other. 1 bushel of corn is, well, a bushel of corn. The CFTC's job is to make sure the markets where these raw goods are bought and sold are fair and free from manipulation. For decades, these two agencies stayed in their own lanes. The SEC handled the world of corporate finance, and the CFTC handled the world of raw materials. It was a clean divide. Then, crypto came along and blew that divide to smithereens, because it forced them to ask a question that sounds simple, but is so profoundly complex it has tied the US government in knots. What is a cryptocurrency? Is it a security like a share of Apple stock? Or is it a commodity like a bar of digital gold? The answer to that question changes everything, and the SEC believes it has the answer. Their ultimate weapon in this fight is a legal doctrine that's almost a century old, born from a case involving a Florida orange grove. It's called the Howey test. And according to the SEC, this old test is all they need to claim jurisdiction over almost the entire crypto universe. So what is the Howey test? Forget the legal jargon. Let's break it down. Imagine you and your friends hear about a brilliant new chef who wants to open a revolutionary restaurant. She doesn't have the money, so she sells gourmet tokens. You buy a token. Now let's apply the test. First, is there an investment of money? Yes, you paid cash for your gourmet token. That's prong one. Second, is it in a common enterprise? Yes, you and all the other token buyers have pooled your money together to fund this restaurant. You're all in it together. That's prong 2. Third, is there a reasonable expectation of profit? Of course. You're not buying the token just for fun. You believe this chef is a genius, the restaurant will be a massive success, and the value of your gourmet token will skyrocket. You plan to sell it later for a huge profit. That's prong 3. Now, for the fourth and most critical prong, are those profits derived from the entrepreneurial or managerial efforts of others? Absolutely. Your token isn't going to become valuable on its own. Its value depends entirely on the chef and her team, on them finding a location, designing a menu, marketing the restaurant, and cooking amazing food. You are betting on their work to make you rich. According to the SEC, if the answer to all 4 of these questions is yes, then that gourmet token isn't just a token. It's a security, and the chef should have registered it with the SEC, just like a company going public on the stock market. Now look at the crypto world. An army of developers creates a new blockchain project. They hold an initial coin offering, or an ICO, selling their new token to the public to raise money to fund the project's development. People buy the token, expecting its value to go up as the developers build out the technology and create a successful network. The SEC looks at this and sees the exact same thing as the gourmet token. An investment of money? Check. A common enterprise? Check. Expectation of profit? Double check. Profits derived from the efforts of the development team? To the SEC, that's a slam dunk. Check. Therefore, they argue almost every single cryptocurrency out there, with a few notable exceptions, is a security. And every project, every exchange that lists them should be following SEC rules. But the CFTC looks at the same landscape and sees something completely different. They point to Bitcoin. Who is the central management team for Bitcoin? There isn't one. Satoshi Nakamoto, the creator, vanished over a decade ago. There's no CEO, no marketing department, no headquarters. The network is run by a decentralized global community. Its value is driven purely by market forces of supply and demand, just like gold. It functions, they argue, as a digital commodity. And if it's a commodity, it falls under their jurisdiction, not the SEC's. This is the heart of the conflict. The SEC sees centralized teams and promises of profit, screaming security. The CFTC sees decentralized networks and digital assets, screaming commodity. And many cryptocurrencies exist in a confusing gray area in between. Take Ethereum. It started with a pre-sale that looks a lot like a securities offering under the Howey test. But over the years, it has become so vast and decentralized. Does the work of a central team still drive its value? Or has it morphed into a commodity, a sort of digital oil that powers a new kind of internet? This isn't just a philosophical debate for bureaucrats in Washington. The consequences of this turf war are massive. If a crypto token is deemed a security, the project behind it is suddenly facing a mountain of regulations designed for 20th century corporations. The legal costs, the disclosure requirements, it's a burden most crypto startups simply cannot bear. It also means exchanges like Coinbase or Kraken could be considered unregistered securities exchanges, putting them in the SEC's crosshairs. This uncertainty led the SEC to adopt a strategy that the industry calls regulation by enforcement. Instead of writing clear rules for crypto, they decided to sue first and ask questions later. And their biggest target became the company Ripple and its token XRP. In late 2020, the SEC filed a bombshell lawsuit, alleging that Ripple had conducted a multi-billion-dollar unregistered securities offering by selling XRP. The SEC was confident. They believed XRP was a textbook case of the Howey test. Ripple was a company, it had a CEO, it had employees, and it sold XRP to fund its operations, all while promoting its potential to increase in value. But Ripple didn't back down. They decided to fight. They argued that XRP was not a security but a tool for faster, cheaper cross-border payments. A functional asset, more like a commodity. The legal battle raged for nearly 3 years, costing both sides hundreds of millions of dollars, and becoming the most closely watched court case in the history of crypto. The entire industry held its breath, because the outcome could set a precedent for everything. Then, in the summer of 2023, the judge delivered a ruling that stunned everyone. It was a split decision. The judge ruled that when Ripple sold XRP directly to big institutions, those sales were securities transactions. That was a win for the SEC. But, in a groundbreaking twist, the judge also ruled that when everyday people like you and me bought and sold XRP on a public exchange, those sales were not securities transactions. The reasoning was that retail buyers on an exchange weren't necessarily aware they were buying from Ripple or relying on its efforts. They were just trading on a blind market, like any other commodity. This was a huge, unprecedented victory for Ripple and a major blow to the SEC's argument that crypto assets are always securities. But it didn't solve the problem. In fact, it made things even more confusing. It created a bizarre situation where the very same digital asset could be a security one moment and a non-security the next, depending on who was selling it and how. The ruling didn't create a clear roadmap for the industry. It just added more forks, more dead ends, and more fog to an already treacherous landscape. So now you have the agencies at war, and the courts providing conflicting, confusing answers. This regulatory chaos has left American innovators and investors trapped in limbo. The fight between the SEC and the CFTC isn't just a turf war anymore. It's a quagmire. And with no clear leadership from the regulators or the courts, the entire industry turned its eyes to the one place that could, in theory, end the chaos once and for all: the United States Congress. But what they found on Capitol Hill wasn't a simple solution. It was a whole new political battlefield. The factions that descended upon Washington, D.C. weren't just lobbyists in expensive suits. They were two fundamentally different visions for America's financial future, ready to wage a war of ideas on the floors of the House and the Senate. On one side, you had the champions of innovation. This group, a mix of tech-savvy libertarians, forward-thinking venture capitalists, and politicians primarily from states like Wyoming and Texas, saw crypto as the next great American frontier. Their argument was simple, powerful, and deeply patriotic. America doesn't follow, it leads. Just as we led the world in the age of the internet, we must now lead the world in the age of digital assets. They painted a picture of a future where blockchain technology could revolutionize everything from banking to supply chains, creating millions of high-paying jobs and cementing American economic dominance for the next century. Their rallying cry was clarity. They argued that the SEC's approach of regulation by enforcement was like trying to drive a brand new electric car using a roadmap from 1933. It didn't work. It was confusing, it was destructive, and worst of all, it was scaring away the brightest minds and the biggest investments. They warned that if America didn't create clear, sensible rules of the road for crypto, all of that innovation, all of that capital, all of that talent would simply pack its bags and move to Dubai or Singapore or London, leaving the US in the technological dust. Their proposed solution was a new, custom-built legal framework. They wanted to draw a bright line, giving one agency, the Commodity Futures Trading Commission or CFTC, authority over digital assets that behave like commodities, think Bitcoin or Ethereum, and leaving the SEC to handle the assets that were clearly securities. It was a call for bespoke tailoring, not a one-size-fits-all straitjacket. But on the other side of the battlefield stood the guardians of the system. This coalition, led by powerful figures like Senator Elizabeth Warren and SEC Chair Gary Gensler, looked at the exact same landscape and saw something entirely different. They didn't see a new frontier. They saw the same old Wild West, filled with snake oil salesmen, digital bandits, and innocent consumers getting caught in the crossfire. Their argument was rooted in a century of hard-won financial lessons. They pointed to the ashes of FTX, the collapse of Terra/Luna, and the countless scams that had bilked ordinary Americans out of their life savings. For them, this wasn't about innovation, it was about protection. Their message was a stark warning. Crypto is a volatile, speculative asset class riddled with fraud and manipulation. It's the preferred tool of money launderers, rogue nations, and terrorist organizations. To create special, lighter-touch rules for this industry would be a historic mistake. It would be like rolling back seatbelt laws and clean air standards just because a new car company claimed their vehicles were different. They argue that the old rules, the securities laws forged in the fire of the Great Depression, work just fine. If a crypto token looks like a stock, walks like a stock, and quacks like a stock, it's a stock, and it should be regulated as such by the SEC. Their solution wasn't to write a new rulebook, but to enforce the existing one with an iron fist. For them, clarity already existed. The crypto industry just didn't like the answer. For years, these two armies fought to a standstill. Bills were introduced, hearings were held, but nothing ever gained enough momentum to become law. The political trenches were dug too deep. But then, in the spring of 2024, something shifted. The champions of innovation decided to make their move, to launch a full frontal assault with their most ambitious piece of legislation to date. The Financial Innovation and Technology for the 21st Century Act, better known as FIT 21. This wasn't just another bill. This was the big one. It was a comprehensive 200-page blueprint for regulating the entire U.S. crypto market. At its core, it tried to solve that fundamental problem we've been talking about. What's a commodity and what's a security? The bill proposed a new process. A crypto project could launch and be treated as a security under the SEC, but if it became sufficiently decentralized, meaning no single person or group was in control, much like Bitcoin, it could then transition to being regulated as a commodity by the CFTC. It was a direct attempt to create the clear pathway that the industry had been begging for. It was a shot across the bow of the SEC, explicitly designed to limit its jurisdiction and empower its smaller, less funded rival, the CFTC. The guardians of the system immediately declared war on the bill. Gary Gensler himself wrote a public letter blasting it, claiming it would create massive regulatory gaps and undermine decades of investor protection. The White House issued a formal statement saying they strongly opposed its passage. The battle lines were drawn. Everyone expected a purely partisan fight, Republicans for, Democrats against. A bill like this they thought was dead on arrival. But they were wrong. When the vote was called in the House of Representatives, the unthinkable happened. Yes, the vast majority of Republicans voted in favor. But then one by one dozens of Democrats began to cross the aisle. 71 Democrats, including some very prominent leaders, joined the Republicans to pass the bill with a stunning veto-proof majority. It was a political earthquake. For the first time, a major piece of pro-crypto legislation had not just passed a chamber of Congress, but had done so with overwhelming bipartisan support. Why? What changed? The answer is as complex as American politics itself. For some Democrats, it was a recognition that crypto wasn't going away, and that having no rules was more dangerous than having imperfect ones. For others, it was pressure from a growing number of their own constituents who owned crypto and were tired of the uncertainty. And for many, it was a subtle but powerful signal that the political winds were shifting. The crypto industry had spent hundreds of millions of dollars on lobbying and campaign contributions, building a formidable political machine that could no longer be ignored. The vote was a flexing of that new muscle. The passage of FIT 21 in the House was a monumental victory for the crypto industry. It felt like the tide was finally turning, but the war was far from over. The bill then moved to the Senate, a place known as the legislative graveyard, where bills go to die. The Democratic leadership in the Senate had no intention of even bringing it up for a vote. And even if they did, there was still that statement from the White House, a clear threat of a presidential veto. So Congress was stuck in a paradox. The House had passed a historic bill with a veto-proof majority, signaling a clear desire for a new path forward. But the Senate and the White House remained a brick wall. It was the ultimate legislative stalemate. And while the politicians in Washington, D.C. were locked in their ideological struggle, a different kind of power was being exercised from the highest office in the land. Because while Congress debates and delays, the president and his administration have a whole other set of tools at their disposal, tools that don't require a single vote, and that were already being put into motion to shape the future of crypto in America, with or without Capitol Hill. And so, while Congress was basically in a staring contest, the White House decided it wasn't going to wait. On March 9, 2022, President Biden signed Executive Order 14067, officially titled, Ensuring Responsible Development of Digital Assets. Now, for anyone who isn't a political science major, an executive order is basically the president telling the entire federal government, hey, listen up. This is a priority. Get to work on it. It doesn't create new laws, but it directs all the powerful agencies, the Treasury, the SEC, the Department of Justice, to focus their immense resources on a single issue. And in this case, the issue was crypto. This wasn't a one-page memo. This was a comprehensive, whole-of-government strategy. It was the first time the US government had ever formally acknowledged crypto at this level, not as a niche hobby for tech nerds or a tool for criminals, but as a powerful, transformative technology that could fundamentally change finance, the economy, and even national security. The order laid out 6 key priorities, which were essentially 6 different missions assigned to various parts of the government. And understanding these 6 missions is the key to understanding the government's entire game plan. First, and most predictably, was consumer and investor protection. This was the government putting on its sheriff's badge. For years, the crypto space had been called the Wild West, and for good reason. Scams, rug pulls, and outright fraud were rampant. People were losing their life savings on projects that vanished overnight. So the order directed agencies like the SEC and the CFTC to double down on protecting regular Americans. It was a clear signal. The days of launching a coin with a white paper and a prayer, with no accountability, were numbered. The message was, We need rules of the road to make sure people don't get hurt. The second priority was promoting financial stability. This is the big picture. Prevent the next 2008 mission. Regulators have this recurring nightmare where a major crypto exchange or stablecoin collapses, and it's so intertwined with the traditional banking system that it triggers a chain reaction, taking down banks and crashing the stock market. Think of it like building a firewall. The government wanted the Financial Stability Oversight Council, a supergroup of top regulators, to study the risks and figure out how to stop a crypto contagion from infecting the entire economy. They were looking at stablecoins in particular, worrying that a run on a major stablecoin could be like a classic bank run, causing widespread panic. Third on the list, combating illicit finance. This is the one you always hear about. The order tasked the Treasury Department, the Department of Justice, and others to crack down on the use of crypto for money laundering, terrorism financing, and, crucially, sanctions evasion. This became incredibly relevant with the war in Ukraine, as a major concern was that Russia could use crypto to get around international sanctions. This part of the order wasn't about new ideas, it was about pouring more resources into what these agencies were already doing. Tracking blockchain transactions, working with international partners, and making it harder for bad actors to move and hide their money in the digital world. The fourth priority was a bit of a carrot to go with all those sticks. Promoting U.S. leadership in the global financial system and economic competitiveness. This is the America First part of the strategy. The White House recognized that this technology isn't going away. Other countries, especially China, were moving fast. China had already banned cryptocurrencies like Bitcoin, but was aggressively rolling out its own government-controlled digital currency, the digital yuan. The US government realized that if it just banned everything, the innovation, the talent, and the capital would all just move overseas. So, this part of the order was about finding a balance. How can we foster innovation and keep America the center of the financial world, while still managing all the risks? It was a directive to the Department of Commerce to develop a framework for making the US a leader in crypto tech, not just a follower. Fifth was promoting financial inclusion. This is one of the original optimistic promises of crypto, the idea that it could help the unbanked and underbanked. In the US alone, millions of people don't have access to basic financial services. They pay high fees for things like check cashing or sending money abroad. The theory is that crypto, with its lower transaction costs and accessibility via a smartphone, could offer these people a better alternative. The executive order acknowledged this potential benefit and tasked agencies with studying how to make it a reality, ensuring that as this new financial system gets built, it doesn't leave the most vulnerable people behind. And that brings us to the sixth and final priority: responsible innovation. This was the catch-all, but it contained the single most controversial and consequential part of the entire executive order. Tucked inside this section was a directive for the US government to explore creating its very own digital currency, a central bank digital currency, or CBDC, a digital dollar. Let's be crystal clear about what this means, because it is one of the most important financial debates of our lifetime. A US CBDC would not be a cryptocurrency like Bitcoin. It wouldn't be decentralized. It wouldn't be run on a public blockchain. It would be a digital liability of the Federal Reserve, the US central bank. Think of it like the digital version of a dollar bill in your pocket, issued and controlled entirely by the government. The potential benefits from the government's perspective are huge. Payments could be faster and cheaper. It could make distributing government benefits like stimulus checks instantaneous. It would give the Federal Reserve new tools to implement monetary policy. And it would allow the US to compete with China's digital yuan on the world stage, ensuring the dollar remains the world's reserve currency. But the downsides are what keep people up at night. A digital dollar raises profound questions about privacy and control. Unlike cash, which is anonymous, a digital dollar could potentially allow the government to see every single transaction you make. Every coffee you buy, every political donation you make, every book you purchase, could all be tracked. And it gets even more dystopian. A CBDC could be programmable. This means the government could potentially build rules directly into the money itself. For example, they could design stimulus money that expires if you don't spend it by a certain date. They could potentially restrict you from buying certain things like too much gasoline or certain types of food. It opens the door to a level of social control that was previously impossible. This is the heart of the debate. It's a fundamental conflict between the government's desire for efficiency and control, and the individual's right to privacy and financial freedom. President Biden's executive order didn't create a digital dollar. didn't even say we should create one, but it did light the fuse. It ordered an urgent government-wide assessment of the pros and cons, the technology, and the policy implications of creating a US CBDC. The executive order was the starting gun. It set the agenda and unleashed the full force of the federal bureaucracy on the world of crypto. The president had given his marching orders, and now every major agency in Washington, from the Treasury to the Justice Department, was in a race to research, analyze, and report back on how they would tame the Wild West, and what the future of money in America should look like. What they came back with would provide the first real blueprint for regulation, and the recommendations would send shockwaves from Wall Street to your wallet. The report landed like a bombshell. It was called the Report on Stablecoins, and it was the culmination of months of intense debate within the president's working group. And its central recommendation was so simple, yet so profound it threatened to change the very nature of crypto in America. The recommendation was this: Congress should pass a law that requires stablecoin issuers to be regulated as banks. Let that sink in for a moment. Not just money transmitters, not just tech companies, but full-blown insured depository institutions. The same category as Bank of America or Chase, or your local credit union. This wasn't a tweak. This was a complete paradigm shift. To understand why this was so monumental, you have to understand what it means to be a bank in the United States. It means an alphabet soup of oversight. It means the FDIC, the OCC, the Federal Reserve. It means strict capital requirements, stress tests, and regular audits. It means having to hold a certain amount of highly liquid, safe assets to back up every single dollar of deposits. And most importantly, it means FDIC insurance, a government guarantee that if the institution fails, your money is safe up to $250,000. The government's logic was straightforward. They looked at a stablecoin like USDC or the now-defunct Tether, which claimed to be backed one-to-one by a US dollar, and they said, if it looks like a bank deposit and acts like a bank deposit, it should be regulated like a bank deposit. Their greatest fear was a digital-age bank run. Imagine a panic. Millions of people all trying to redeem their stablecoins for real dollars at the same time. If the issuer didn't have enough actual cash on hand, or if their reserves were tied up in assets that suddenly lost value, the entire system could collapse. The stablecoin's peg to the dollar would break, its value would plummet to zero, and billions of dollars in user funds would evaporate in an instant, triggering a catastrophic contagion that could spill over into the traditional financial system. This wasn't a hypothetical fear. Just a few months after this report was released, the world watched this exact scenario play out in horrifying real time with the collapse of the Terra Luna ecosystem. Their algorithmic stablecoin UST wasn't backed by dollars in a bank account, but by a complex relationship with another cryptocurrency. When confidence wavered, a death spiral began. It was a digital bank run of epic proportions, wiping out over $40 billion in value in a matter of days. For regulators in Washington, the Terra Luna collapse was their "I told you so" moment. It was the perfect, terrifying validation of their deepest anxieties. This, they argued, is precisely what we are trying to prevent. The industry's reaction to the president's working group report was split right down the middle. On one side, you had companies like Circle, the issuer of the USDC stablecoin. They actually welcomed the recommendation. Their CEO, Jeremy Allaire, saw it as a path to legitimacy. He believed that becoming a fully regulated national crypto bank would provide ultimate clarity and trust for their users. It would be the golden ticket to mass adoption. On the other side, you had the crypto purists and decentralization advocates. To them, forcing a stablecoin issuer to become a traditional bank was a betrayal of the core principles of crypto. It was re-centralizing the decentralized, putting the old gatekeepers back in charge of the new system. It was seen as an attempt to suffocate innovation under a mountain of old-world bureaucracy. This report became the official blueprint for the White House and the Treasury Department. It was their North Star. But while they were drawing up plans for a new legislative framework built around treating crypto like banking, another powerful federal agency was already on the warpath, armed with a law written nearly 90 years ago. And they had a very different strategy. It wasn't about writing new rules for the future. It was about using old rules to punish the present. This was the era of the Securities and Exchange Commission, the SEC, and its chairman Gary Gensler. And their strategy had a name: regulation by enforcement. Instead of providing a clear set of guidelines for crypto companies to follow, the SEC's approach was to sue them, one by one. The idea was to create the rules of the road not through legislation but through litigation, to establish legal precedents in court that would then apply to the entire industry. It's like a police department refusing to post speed limit signs, and instead just pulling people over and giving them massive tickets, letting drivers guess what the speed limit actually is based on who gets ticketed. It created an environment of immense fear and uncertainty. The SEC's entire legal arsenal is built around one single powerful concept: the definition of a security. And for that, they rely on a 1946 Supreme Court case involving a citrus grove in Florida. It's called the Howey test, and it is arguably the single most important legal doctrine in the entire crypto world today. The test has 4 parts. It says an investment contract, which is a type of security, exists when there is 1. An investment of money, 2. In a common enterprise, 3. With a reasonable expectation of profits, 4. To be derived from the entrepreneurial or managerial efforts of others. Think about it like this. You and your friends pool your money, an investment of money, to buy a plot of land in an orange grove, a common enterprise. The company that sold you the land also manages the trees, harvests the oranges, and sells them, promising to give you a share of the profits, the expectation of profit from the efforts of others. You're not flying to Florida to pick the oranges yourself. You're relying on the company to do the work. According to the Supreme Court, that's a security. Gary Gensler and the SEC looked at the vast majority of cryptocurrencies, and they saw orange groves everywhere. They argued that when you buy a token, you are investing money into a common enterprise, the crypto project. You are doing so with the expectation that the price will go up, giving you a profit. And that profit depends almost entirely on the efforts of the core development team, the foundation, and the charismatic founder who is promoting it on social media. Under this interpretation, almost every crypto token, besides perhaps Bitcoin, is an unregistered security. And if they are securities, then the exchanges that list them, like Coinbase and Binance, are operating as unregistered national securities exchanges. This wasn't just a theory. The SEC put it into action in the most aggressive way possible. Their first major target was Ripple Labs, the company behind the XRP token. In a blockbuster lawsuit filed in late 2020, the SEC alleged that Ripple's ongoing sales of XRP constituted a massive, multi-billion-dollar unregistered securities offering. The case dragged on for years, costing Ripple over $100 million in legal fees and becoming the defining legal battle of the industry. The outcome was a landmark split decision. The judge ruled that Ripple's sales of XRP to institutional investors did constitute a securities transaction. But, crucially, the sales of XRP to regular people on public exchanges did not. It was a partial victory for Ripple, and it threw a wrench into the SEC's argument that all tokens were inherently securities. But the SEC was undeterred. They doubled down. In the summer of 2023, they filed sweeping lawsuits against the 2 largest crypto exchanges accessible to Americans, Binance and Coinbase. These weren't just about a single token. The SEC was going after the core infrastructure of the American crypto market. They accused Coinbase of operating as an unregistered exchange, broker, and clearing agency all in one, and listed over a dozen popular tokens, like Solana, Cardano, and Polygon, as securities. The lawsuit against Binance was even more damning, alleging outright fraud and the commingling of customer funds. Suddenly, the threat was no longer abstract. It was existential. The SEC wasn't just trying to tame the Wild West. Many felt they were trying to burn the whole town to the ground. You now had 2 factions within the U.S. government with 2 fundamentally different approaches. The White House and Treasury, following the president's working group, wanted to bring crypto inside the existing regulatory perimeter to wrap it in the familiar rules of banking. The SEC, on the other hand, seemed to want to litigate it out of existence, using the blunt instrument of securities law from the 1930s. These 2 powerful forces were on a collision course, creating a regulatory civil war. And caught in the crossfire? Everyone. The investors, the builders, the everyday Americans who just wanted to participate in this new financial frontier. The question was no longer if regulation was coming. The question was which version would win, and what would be left of the American crypto industry when the dust finally settled. And so, America found itself at a crucial fork in the road. Down one path was a future built on bespoke, forward-thinking legislation. A path that acknowledged crypto wasn't just old wine in a new bottle, that it required a new set of rules for a new kind of technology. This was the path championed by a growing bipartisan group in Congress who saw the potential for innovation, job creation, and American leadership in the next generation of the internet. They argued that you can't regulate a decentralized network the same way you regulate a company with a CEO and a boardroom. They warned that without clear rules of the road, the brightest minds and the most innovative companies would simply leave, taking their talent and tax dollars to friendlier shores in Europe, Asia, and the Middle East. This wasn't just about protecting investors. It was about securing America's role as the world's financial and technological leader for the next century. Down the other path was a future defined by enforcement. This was the path of the existing regulators, most notably the SEC, who argued that the rules were already clear enough. In their view, almost every crypto asset aside from Bitcoin was an unregistered security. The solution wasn't new laws, but aggressive application of old ones, laws written in the 1930s to regulate stocks and bonds. Their mission, as they saw it, was singular: protect the American consumer from the rampant fraud and manipulation they saw in the crypto markets. They pointed to the spectacular collapses of FTX, Celsius, and Terra Luna as Exhibit A, B, and C for why this industry couldn't be trusted to regulate itself and needed a firm, unyielding hand. To them, the calls for clarity were just a smokescreen, a crypto industry lobbying effort to get a lighter touch, a weaker referee. For years, these two philosophies were locked in a stalemate, a regulatory tug-of-war that left everyone in limbo. Projects didn't know if they were breaking the law just by existing. Investors didn't know what protections they had. And the United States was quickly earning a reputation for being the most confusing and hostile place in the developed world to build a crypto company. But then, slowly at first and then all at once, the ground began to shift. The first major tremor was the Financial Innovation and Technology for the 21st Century Act, or FIT21. This was the most comprehensive piece of crypto legislation ever to be seriously considered in the United States. And its core idea was revolutionary in its simplicity. It proposed to end the turf war between the SEC and the other major markets regulator, the CFTC. The bill created a process to determine if a crypto asset was a security, to be regulated by the SEC, or a commodity, to be regulated by the CFTC. It laid out a clear path for projects to launch and decentralize over time, eventually transitioning from SEC to CFTC oversight. For the first time, there was a rulebook, a set of definitions, a way for good faith actors to know what lane they were supposed to be driving in. And then the unthinkable happened. In May of 2024, the FIT21 bill passed the House of Representatives with a stunningly strong bipartisan vote. It wasn't just one party pushing an agenda. It was a broad coalition of lawmakers from both sides of the aisle sending a clear message. The era of ambiguity had to end. The status quo was no longer acceptable. While the White House issued a statement opposing the bill in its current form, it notably stopped short of a full-blown veto threat, signaling that even the administration knew the tide was turning. This wasn't an isolated event. Around the same time, Congress passed another resolution, again with bipartisan support, to overturn a controversial SEC accounting rule known as SAB 121. This rule had effectively made it impossible for large, regulated banks to act as custodians for crypto assets, boxing them out of the ecosystem. The vote to repeal it was another direct challenge to the enforcement-first approach, with Congress telling a regulatory agency that it had overstepped its authority. While the political branches of government were beginning to find common ground, the third branch, the judiciary, was weighing in with even more force. The courts became the ultimate referee in the SEC's regulation by enforcement campaign, and the SEC started losing. In the landmark case against Ripple, the company behind the XRP token, a federal judge ruled that while direct sales to institutions were securities offerings, the sales of XRP on public exchanges to everyday people were not. It was a devastating blow to the SEC's core argument that nearly every token was a security in all contexts. Then came the Grayscale case. Grayscale had been trying for years to convert its massive Bitcoin trust into a spot Bitcoin ETF, which would allow investors to get direct exposure to Bitcoin through a traditional brokerage account. The SEC denied them time and time again, while simultaneously approving Bitcoin futures ETFs. Grayscale sued, arguing the SEC's position was arbitrary and illogical, and the court agreed. A federal appeals court delivered a scathing rebuke to the SEC, calling their denial arbitrary and capricious, and forcing them to reconsider. That single court victory directly paved the way for the wave of spot Bitcoin ETFs that launched in early 2024, opening the floodgates for mainstream investment and legitimizing the asset class in the eyes of Wall Street. So, after all this drama, all this conflict, where does that leave you, the beginner trying to make sense of it all? It leaves you in a profoundly more hopeful and clearer place than just a couple of years ago. Here's what you need to understand. First, comprehensive regulation is no longer a question of if but when and what. The passage of FIT 21 in the House, even if it doesn't become law in its current form, has fundamentally changed the conversation. The political will to create a workable framework is now undeniable. The chaos you've seen is the messy, but necessary process of a new technology being integrated into the world's most sophisticated economy. Second, the security versus commodity distinction is everything. This is the central question that bills like FIT 21 are trying to answer. The outcome will determine which agency regulates which assets, what disclosures are required, and which platforms are allowed to trade them. As an investor, understanding where a token might fall on this spectrum will be crucial for understanding its long-term viability in the US market. Third, the first and most likely area to see a bill signed into law is stablecoins. There is broad, bipartisan agreement that we need a federal framework for stablecoins, which are the lifeblood of the crypto economy. A law regulating stablecoins would be a monumental first step. It would provide confidence in the digital dollar, set standards for reserves and audits, and provide a solid foundation upon which the rest of the crypto ecosystem can be safely built. And finally, and perhaps most importantly, this is the end of the beginning. We are moving out of the Wild West phase. The narrative that crypto is a lawless, unregulated space is becoming obsolete. What's emerging is a uniquely American approach, one that seeks to balance innovation with consumer protection, one that leverages the strengths of our existing capital markets while making room for a new technological paradigm. The future of crypto in the United States won't be a separate parallel system. It will be an integrated one. It will be tokenized assets sitting in the same portfolio as your stocks, managed by regulated banks, and overseen by a clear legal framework. The journey has been a turbulent one, filled with hype, fear, and profound uncertainty. But the path forward is becoming clearer every day. You're not too late. In fact, you're arriving at the most critical moment, the moment when the blueprint for the next financial generation is being drawn up. Understanding these regulations isn't just about avoiding trouble. It's about understanding the foundation of a new economy you will be a part of. The dust hasn't fully settled, but for the first time, we can finally begin to see the shape of the landscape that's being built. And now you have a map,